Oscillators. The basics of oscillators. Oscillator indicators. What are oscillators? Think of a ECG machine, the heart monitor, how it moves up and down very quickly. Also, perhaps like a lie detector test, the pin on the paper, how it moves up and down. That motion is an oscillation. It is moving up and down. It's oscillating. There are indicators that move up and down and can signal things. Here is a list of some of the most popular, but there are so many. The RSI, which is the Relative Strength Index. The MACD, which is the Moving Average Convergence Divergence. The Stochastic, the Williams Percentage Range. The Commodities Channel Index. Awesome Oscillator. Sounds like a good one, doesn't it? Awesome Oscillator, AO. There are even more. ATR, Average True Range. There are many oscillators, just like there are many types of moving averages, as covered in the previous video. I'm not going to go through them all. I just want to teach you the basics of oscillators, how they work, how you can use them, just to give you a foundation in technical analysis. So we'll look at the first three: the RSI, Relative Strength Index, the MACD, Moving Average Convergence Divergence, and the Stochastic, and how you can use them to analyze price and trade the financial markets, more specifically Forex. So we're going to start off with the RSI. So I have my candlestick chart, just like I normally do. This is pound US dollar. It's the 4-hour time frame. We have a nice uptrend here, but you'll notice at the bottom here we have an oscillator. We have an indicator that's moving up and down within a range. Okay, so if you think of a sideways market, how price moves up and down between a support and resistance area, that's how an oscillator works, moves up and down within a range. Now the way this RSI is generally used is if the indicator moves above the range of 70, just like it does here, this downward arrow, that can mean that a market is overbought and price could come down. We also have a 30 line here, and what can happen is if the indicator moves down to this line or below the line, that can signal that a market is oversold. It's come down too strongly, it's too bearish, and things could reverse. Okay, so the indicator down at the 30 or below can signal a reversal to the upside. The indicator above 70 or at 70 can signal that things could reverse to the downside. So that signals these potential reversals. So we look at this bottom one. The RSI signaling around 30. I've got an arrow here. If we look at that on the price chart, you can see we did get a reversal. The market was oversold and we started moving higher. So here's the signal and here's the price action here. It moves up. If we look at this arrow here, so when the oscillator is above that 70 range, that's signaled around this sort of area. Once again, we had this reversal down. So in this case, it can signal the tops of swing highs and the bottoms of swing lows. So if you're looking to join a trend or exit a trend, this RSI can come in handy. Alternatively, if price is at a support and resistance with an RSI signal, that can signal that the support and resistance is going to hold. So if you had price at a key resistance area and the RSI saying the market is overbought, that could signal a reversal at that resistance. And there'll be lots more content about this in future. I'm just trying to teach you the basics of how to read these indicators, what they look like, and how you can use them in trading. There's lots of ways you can use these indicators. So here's the RSI again. Look at the arrows and look at the corresponding arrows on the chart. So with the arrow on the oscillator, the arrow on the chart, and just look at the reversals that happen when this indicator signals overbought and oversold. So overbought is the higher end of the range, oversold is the lower end of the range. If something's oversold, it could become bullish. If something's overbought, it could become bearish. Now this is not always going to work. For example, there's a signal here on the RSI that doesn't really correspond. So this suggests, the indicator suggests that price could become bearish, and it doesn't really, kind of actually moves higher. So there are false signals, just like there is false signals with moving averages or any other indicator. They do not always work. We can see in this example there is a good rate of signal success. Now, something I haven't mentioned in this course is you're not meant to just trade these signals. You're never meant to trade indicators. The signals that an indicator provides is not meant to be traded. A trader does not look at an indicator and buy or sell based on what an indicator is telling them. The indicator is meant to complement your analysis. It's meant to be part of your analysis. So you look at the price action, you look at fundamental analysis, you look at indicators, you put all these things together to create a detailed trading strategy that will give you an edge. There'll be more about this later on. This is the MACD. So once again, we have this sort of up and down motion. It's oscillating. It's an oscillator indicator. Now, the way the MACD can work is it signals acceleration. It signals momentum. When these black bars move down and this red line, this red dashed line moves below that center line, so with the center line going across here, the bars are either below that center line or above it. When the bars are below and this red dashed line moves below, it can signal bearish momentum. So this is signaling bearish momentum, which is here. And if we look over here, the bars start coming down and get bigger. The red dashed line moves down past that center line too. That signals bearish momentum. So it's coming down like this, bearish momentum. Once again, there can be false signals with this MACD, such as there was here. This would signal bullish momentum. The bars are now above the center line. The red dashed line is above. Things actually become bearish. So there are false signals with oscillators, with the MACD, just like the way it is with every indicator. This is the stochastic. Once again, we have this up and down motion. It's oscillating. Now, this is probably the hardest indicator and the hardest way to use an indicator covered in this video. So this is called divergence, and this is used by a lot of traders, but it is much harder to understand than an overbought RSI or oversold RSI or some sort of cross of a center line. The way divergence works is it's all based on swing highs and swing lows of a trend. So we think of a trend where you get higher highs and higher lows, so higher lows here, higher highs of an uptrend. Divergence is when this stochastic actually signals the opposite to what the trend is forming. So if you have an uptrend here, and when we have these higher highs, higher lows, but the stochastic is forming lower highs, so we have an uptrend, but with this divergence, we have lower highs here, lower highs, even though price is uptrending. That can signal the end of the trend, which happens with like this head and shoulder pattern, and price comes down. We then have this downtrend, so we have lower highs, lower lows, but the stochastic forms higher lows, 1, 2, 3, and we have an uptrend. So this divergence, these opposite highs or lows compared to the price action on the chart, can signal that a market is going to reverse, a trend is coming to an end. Once again, it can give false signals. We have a clear uptrend here with higher highs, higher lows, but the stochastic forms lower highs. And because it forms lower highs, that would signal the end of this uptrend, but it carries on going. So nothing is guaranteed, but you're not meant to trade divergence all by itself. You're not meant to trade MACD crosses all by itself. You're not meant to trade overbought, oversold RSI signals all by themselves. You use these indicators along with your moving averages, along with your price action analysis, along with fundamental analysis to form a very varied trading plan that gives you an edge. It's not enough to trade engulfing candles by themselves. It's not enough to trade the RSI by itself. This is all just part of the analysis, part of technical analysis. We are coming to the end of this series. There is one video left. In this series, I've taught you the basics of price action, support and resistance, engulfing candles, other price action setups, how price swings and trends, how it ranges, patterns price creates, and lots of other things. I've taught you the basics of technical indicators, moving averages, oscillator indicators, how we use these indicators to analyze price. There is one more video in this series that will cover another set of technical indicators, which is technical overlays. That'll be the last video, and then you will have a strong foundation in technical analysis that you can build upon. Please practice what I've taught you. If you've joined the series on this video, go back and watch from the beginning. You'll learn so much more. Any questions, use the comment section below. I am here to help you. I'll speak to you in the next video.